Every day, chat and chart live during the New York session. Here, real traders share the raw truth, their mindset, technical analysis, and execution. This is where real traders show their skill set. Welcome to Tradin TV. This is your stage to shine.
Morning, guys. How's everybody doing? Hope everybody's having a great holiday so far. Obviously today and going into the end of the year is going to be very slow in the markets. So what I'm going to do is go over a recap of what we've, how we've traded this whole year and how I kind of go back and annotate all of my charts, especially just from a monthly standpoint. Now you guys can do the same for intraday, which, I'll show a couple examples of that as well. But we'll kind of just walk through some of these markets and, maybe I'll just run through like dollar index and one of the index markets. So usually at the beginning of every year, right, markets start out a bit slow. So usually at the end of every year, right, and this goes for end of every month, end of every week, end of every day, I sit down and analyze the candle that just closed. So obviously last year, we got a pretty bullish closer at the end of the year, but we're trading up into this wick. Not only that, but we're trading up into this bearish order block. So we had to be very, very cautious of any higher price action from where we are, right? Because if we don't break through this level, well, essentially we're just creating lower lows and lower highs in the dollar index. So that's first of all, right? Hop over to your yearly chart. Now, if you don't pay for TradingView, you can't get this data because this is a custom time frame. But you can analyze like the weekly or something like that just to figure out what the yearly candles look like. Okay. So dropping down into the daily time frame, I'll mark out my yearly open. So we have yearly open. Right. And then we have our monthlies. So our monthly open, right? So yearly open is the same as obviously January's open. And then you mark out February, right? Beginning of February. So that goes up till February 3rd. So in here, right, what are we looking at? Well, we have this bullish fair value gap from the prior year. And I'm just going to walk you guys through all the concepts that I see that should provide some opportunity in the marketplace. Okay, so we run above this short-term high here. And then we get a nice retracement down here into the what? Back into the fair value gap, back into this fair value gap here, and then you can look at this as our order block. We get a retracement in here, and then we get another rally up to this short-term high here. And I'm going to mark every short-term high as STH. I'll make this text a little bit smaller, just because we're probably going to annotate a lot in here. So we get a run above this short-term high, right? And then we get a nice closure here and a swing point, right? So this here is a swing point, which I'll probably use an X or something. All right, so you get a swing high here, and then you get follow through on the following days. We have a swing high, right? Because we have a high, a higher high, then a lower high. We get a closure back under this short-term high. And then all of a sudden, this market is now leaning bearish. We get follow through here. Yes, we get this candle that retraces a bit, takes out two previous days' highs. We have previous days' highs being ran out. And then this day, I'm assuming, is probably a news day. You guys can go back and take a look, the 20th of January, if there's news. And then we get this run lower here, right? This, however, creates what? We have equal lows being created here. Then we get a nice retracement up into this wick. And then we get follow through here. This break lower creates a market structure shift, right? Because we get a closure through this swing low. So we have a closure through that swing low. We fill in more of this fair value gap, right? We basically hit the low of that fair value gap, and then we get a nice retracement. This retracement, we have this very long wick, and then that starts February. February, we come up and take out what? Another short-term high here. We have a short-term high here, but then we don't get any follow-through, right? So we take out the short-term high, and then we get this closure here. The next day, trades higher, up into the wick, and then close lower. Next day, close lower. Then we get a retracement into where? This bearish fair value gap. All right, so we have a small retracement into this bearish fair value gap, right? And then it takes some time to roll over. We'd spend a couple days running out previous day's highs, but then closing lower. Get a nice closure here. And then this following day, boom, another very large bearish candle, which what? Creates another market structure shift. We get what? Another retracement into a bearish fair value gap. Once this gets down here, though, and we're trading at pretty steep discount, we get a quick retracement, running out a lot of this buy side liquidity that's built up earlier in the month. We have this liquidity being ran out, and then we have this old swing high being taken out. So we have another short-term high being ran out. We fill in the whole fair value gap, and then we get a nice rejection. This creates a balanced price range. Now, we don't need to retest the balanced price range, right? If this market is very weak, and then it just continues dropping. Another market structure shift here. Well, actually, this is our end of month. All right, so you guys can see here how this month traded. We were basically in a consolidation, and then we started getting real steep discount or steep markdown. Right, so we have a bit of consolidation in January. February opens, takes out a short-term high, and then closes lower. So we have, this is our yearly open, which you probably hide for now, and just mark out a monthly open. We'll make this blue, and we'll make it dotted. We do the same thing, February. We have another monthly open, right? You can see that it doesn't spend a whole lot of time above that monthly open, just taking out short-term liquidity and then rolling over. Then once it rolls over, let's say you had a hard time trading January. Once we roll over, now we have a bearish fair value gap that we can look at. All right. And then this is guiding us lower because we are getting market structure shifts. We're respecting bearish fair value gaps, and we're pressing lower. Another market structure shift, bearish fair value gap, presses lower. We get a run on this short-term liquidity, right? Nothing really changes on the higher time frame. We're just filling in this fair value gap. That new month opens up. What do you get? Well, this leads us to April, and then we have a monthly open here. Now, this monthly open, we didn't get any price action above it. So once this market drops off and it expands lower very quickly, you guys can see the rest of the month kind of just consolidates, right? Consolidates, but it trades up into this bearish fair value gap. Now, usually when you see large markdowns like this and you see small consolidations, it's usually not going to go up to this fair value gap all the way up here because the market is extremely weak. So it's only going to retest this first fair value gap here. And if it goes higher into here, it's not as weak, right? So we get a retest into this fair value gap, right? 50% of this fair value gap is actually respected. And then we get this nice expansion lower again. All right, we get a retracement into where? This volume imbalance. I usually make my volume imbalances orange. Yeah, higher time frame trends usually continue for months, right? And this is how I annotate all my charts just to try and anticipate what's going on in the marketplace and how I can get in sync with that on the higher time frame. right, so you guys can see here that we have a very large expansion up through like the third week of April. And then the last week we get a bit of a retracement, right? And usually this is where you need to pay attention where you are as far as the calendar. Usually you'll see a low being printed, and then the last week of the month you might just get some small retracement. So you guys can see here, we got this nice run lower, and then the last week of the month trades higher. Here, got a nice run lower. Last couple of days of the month, trades higher. Right here, trades lower. Last week or 2 weeks of the month, consolidates and drifts higher. Here, same thing. We get this nice expansion lower. Last couple of weeks of the month, or last couple of days of the month, sorry, trades higher to close out the month. This is where seasonal tendencies go straight to the trash can. I typically do not rely so much on seasonal tendencies. I think a lot of people, especially me, when I started learning seasonal tendencies, I would look at the seasonal tendencies and be like, this has to do this because that's what the seasonal tendencies say. You know, they're really just meant for, you know, just as a guide. That doesn't necessarily mean that it has to follow what you're looking at. So May, all right, we're kind of slowly getting into the summer months. We get a closure above this down close candle. All right, so we have this closure above the down close candle. And then the market trades higher, trades into where? This fair value gap. If we mark out this Fibonacci here to here, we're just trading up into a premium again. All right, this fair value gap rests in a premium, right? Which the market does lose steam, right? You guys can see here that we never trade to a Fibonacci level. If you were to draw out this fib, right, we never trade to that because the market is extremely weak. And then we have some relative equal lows being built up at the lows. All right, so they engineer the liquidity at the lows. They send it a little higher into this fair value gap, and then they flush them out. In here, right, we do get this retracement into this OTE level where the fair value gap is resting in a premium, right? We fill in the fair value gap and then it rolls over. Let's say you're trying to get short on this market, but you don't know where exactly. You know, maybe you want to wait for a closure below this up close candle. We have this up close candle. We close through it, and then we get follow through for a couple days after that. Right, this is just a retracement into this volume imbalance. Oh, geez, come on. We have a small volume imbalance there. I'm not going to put the text because you probably won't be able to see it. And let's talk about this rally first. So we have a closure above this down close candle. And then going into the next month, we have a bullish fair value gap that appears heading into the next month. All right, and this is a short-term long just to fill in some of this. Now, again, when you're trying to trade counter trend, it's much more difficult to find, you know, where to pick your target, because in a trend, when a market is trending lower, it's much easier to place your target at previous lows because they're much more likely to be taken. Whereas if you're counter trend trading, if you put your target all the way at the high, you don't know where it's going to go. You don't know if it's going to trade up to these two candles here, right? Of these as a bearish order block. You don't know if it's going to go take out some short-term liquidity. You don't know if it's going to trade up to 79% or up here before it turns around. So trying to pick an internal range liquidity target is much harder than if you just target the lows. So if you get short, you can target these lows in here with much greater probability because at some point they will go take those out. So, you know, we do get a slight retracement into the end of the month, but overall May kind of closes where it opened. All right, going into June. All right, what do we see here? I see this fair value gap here, right? That is now an inverted fair value gap. We have this inverted fair value gap that carries over from the previous month. This is where markets can be very tricky, right? So you guys can see anytime somebody shorted it inside of this inverted fair value gap, the market went lower, right? It was struggling a lot to try and get through this inverted fair value gap. Here we have a market structure shift. We can anticipate that the market is going to remain weak. It's all gaps in liquidity. Yeah, exactly. That's pretty much what we're looking at. Right? We're looking at gaps in liquidity because gaps in liquidity show us, well, they show us participants in the market. They show us momentum, right? So momentum or imbalance is our gaps, and then liquidity shows us where the stops are resting. You guys can see that we have a lot of engineered liquidity up here, right? So we have short-term highs. We have this equal high liquidity. You guys can see that once we take out this low down in here, we're in a discount. It trades up to short-term liquidity up here, takes out this short-term high, and then rolls over again, going into the end of the month. All right, so we have a new month coming out. We have a small fair value gap here that gets inverted. We have a bullish inverted fair value gap. All right, but again, you're trying to pick an internal range liquidity target. It's much more difficult to do. We get a closure above this down close candle and a closure above this down close candle. We get continuation up to where? Into this level here, which is I would deem as our order block. We get a nice retracement down here to where? This bullish fair value gap. The retesting of this bullish fair value gap is very nice because it basically hits the high of this candle here. And then turns around. We get a nice closure above this candle. And then when we continue higher, right, taking out this short-term liquidity and then this short-term liquidity. So again, when you see a very shallow run on liquidity here, it can be susceptible later for a run because all of this here is not a deep flush on liquidity. Like this little wick right here is not taking out a lot of the stops that are resting above these highs. Right, so July was a very bullish month. Right, so we have this run higher, right? We have this displacement leg, and then we get a retracement down to discount. So if we draw the fib from this high, or from this low to this high, as you can see here, it retraced back to OTE pretty much, 70%. And then they bought it up again. And then we get a nice closure above this down close candle. We're in a discount. We have liquidity above us here. It runs to that liquidity. Okay. And then on the first day of the month, we get a run on this previous monthly high. You keep avoid getting stuck in April, thinking the uptrend will keep going. Yeah, you just keep following the price action and accepting the losses because not every April's like that. And not every month is going to be the same either. Months are drastically different. Sometimes we're active in the wintertime. Sometimes we're active in the summertime. But I tend not to look at months and just say, you know, it's April. It's going to be a slow month. Right? And slow month by you mean like the index markets? Because this April here was very active until you get this major expansion and then it goes sideways. So if you're trading in April, you need to try and make all your money in these few days where the market is really pushing lower. And then the rest of the time, you're just trying to survive. Right? So we have this run on the short-term liquidity, and then we get another breakdown, right? Taking out what? Taking out this, bullish fair value gap, and creating another fair value gap here. We have a balanced price range. So we have this bearish fair value gap appearing on the first. We have another couple days where it trades higher into the fair value gap and then trades lower again. And then we have another fair value gap that appears here. Right? You can see that sometimes it does close through those levels and it manipulates. So these gaps are not always precise like this one. Right? And that's just something you guys have to get comfortable with. So this bullish fair value gap, you guys can see that it obviously respects that level to the tick. It's not always going to do that. And this is where you have to be comfortable with having a win rate that is not 100%. Okay, because sometimes you might be trading these fair value gaps many times before it actually pays you out the way you want it to pay you out. So even if you take a couple losses in here, 1, 2 losses, right? Ideally, maybe you get short on this day, and then maybe you get short on this day, and then maybe you get short on this day. These 2 winners in here, well, let's say if you got short on this day and you traded down to these lows, that would have been a win, right? And then let's say you got short again as it traded up in here and you targeted this low down here. These 2 trades in here should make up for the losers that you maybe sustained in here. Okay, that is proper risk management. All right. So you guys can see here that we have a lot of liquidity being built up below these lows in here. Right? It goes up, trades to this in fair value gap again. And then a couple days into the month, we get that run lower, right? And then eventually a run all the way down to this low. And that's what I mentioned by you stay on side, right? We don't know if it's going to take out this internal range liquidity or this one, or maybe even just this one. Because if the market is overall bearish, it's more likely to go take out all the lows than it is to take out every single high. Yeah, it feels like you stole something when you trade PD raise that trade to the tick. Sometimes, I mean, again, not every PD array is going to be respected perfectly, especially when we're going through a bit of a consolidation period. These levels can be much more manipulated, right? They're more imprecise. So you guys can see here that we had a very large day on the first day of the month. And then outside of that, this is really more of a day trader's paradise, right? You're basically just trading daily levels or intraday levels because this market doesn't really move too much in August. It's basically just sideways. Yes, there's opportunity, but it's more so you kind of have to be in and out in the same day. Otherwise, you expose yourself to risk. Now, you can't, there's no way to really anticipate that other than anticipating maybe we're in a summer month and that markets are possibly going to be a little bit slower, right? So let me go into September. All right, what do we do in September? Mark out all these PD rays in here. So we have this run here into this bearish fair value gap. Then we get an inverted fair value gap here. So we break below that level. This market trades lower. It takes out some lows. Then it retraces higher into the inverted fair value gap again, taking out some intraday liquidity. And then rolls over again. Right? So rolls over again, trades down to a discount, taking out what? A previous monthly low. And then it turns around. And then we get a bullish inverted fair value gap here. Get a bullish inverted fair value gap. Then we take out some of this liquidity in here. You guys can see that we don't take out the previous monthly high. We get very close to it. But as it's trading down into this level, right, maybe positioning yourself the following day, anticipating that it's going to trade higher because we have a inverted fair value gap overlapped with a bullish fair value gap, right? And maybe you're just targeting this high or this high, right? You're not expecting to trade all the way up here. Now, the following month, though, right, you guys can see that we are still respecting these bullish fair value gaps. Get a nice retracement here. Draw a fib here, this low to this high. We have discount, trades down to discount, runs to this high, runs to target one. Now, I know this is all in hindsight, but this is exactly what you guys should be doing. Annotating your charts every single month to try and anticipate or try and figure out where you went wrong, where you could have seen opportunity. And it's about getting that repetition so you can anticipate what's going to happen next, right? If you sit down and annotate all of your charts every single day, right? Let's say you sit down and you annotate a 5-minute chart every single day. Eventually you will see patterns. And this is mostly about pattern recognition. It's about seeing things occur over and over and over again, and you getting comfortable with that, right? So we have this bullish fair value gap here. Get the run to target 1, target 2. It trades up into this bearish fair value gap that's all the way back here. All right, and then we get a nice retracement. Trading into where? Another bullish fair value gap. We get another bullish fair value gap. And I wouldn't even have to, mark this out to be able to see it, but we have this. Now we have this swing low to this swing high. Right, we have another fib level. We have this swing low down here. This swing high. Right? That's where you draw your fib. It comes back down to a discount, trading into this bullish fair value gap again. And then where do you target? You try and target this previous high. And then we have a previous monthly high that's all the way back here. And once we take out this previous monthly high, you guys can see here in November, mark out December here. November takes out the previous monthly high and then trades lower, right? Once we get this inverted daily fair value gap, I want to lean short just as a retracement down into internal range liquidity. But now again, the target for internal range liquidity is much harder to determine because we don't know if this thing is just going to continue completely roll over or if it's going to stop somewhere in here inside of this range. You guys have another swing low and then a swing high here. All right, so if you position yourself inside of this discount, it just runs to this liquidity again, taking out this short-term high. Right, and basically where you're trying to get long is if you see these down close candles being closed through, right? That to me is a very strong sign that the market is ready to turn and take out some of this liquidity. Maybe you just want to target this fair value gap in here, right? You just want to target this, take profit somewhere in here, or maybe you want to target this gap, right? Because you have this candle here that doesn't have a wick, right? So you guys can see the open and the high over here, where it says OHLC. The open and the high are the same price. So if I hover over that, you can see that the open and the high is 100.108. Usually when you get candles like this that don't have wicks, they become very strong magnets for price later. Right? And it's very unlikely to continue without at least going to take that level. Right? So not only that, but we have this candle here that doesn't have a wick also, which I've been talking about with you guys for the last couple of weeks. We have this candle that's all the way down here that doesn't have a wick. Now, it doesn't have to go there right away because as this thing was rolling over, I thought we were going to go take it out. But then we obviously didn't. I was just trying to anticipate that it would. Will I be active again in the market after the holidays? Yes. January 5th is when I plan to come back. Not next week, because next week is New Year's, right? It's basically the end of the year, 29th, 30th, 31st. Here's New Year's Eve, and then we have New Year's. So the 5th is probably the earliest I'll be really looking at markets. So even though this market in November was kind of sideways, there was still opportunity in here, right? You have OTE in here, where you possibly want to get long to this short-term high over here. And then you guys can see here, after we take out the short-term high, it really struggles to trade higher. And then we get a closure through this, which turns this into an inverted fair value gap. And then we resume the downtrend in December. Right, in December, we can basically see that there really hasn't been any bullish price action. We have had very small retracements intraday, or not intraday, just a couple days that have been bullish, which are totally okay. but then we get displacement lower. And these are the days where you have to protect yourself, right? If you're bearish, you have to protect your capital on the days where the market is not trading in your favor. Because if you don't, you're going to miss out on these days, right? Where the market is trading in your direction. So not only do we have that volume imbalance, it trades up into a fair value gap. And it's nice breakdown lower. Here, we don't trade to the fair value gap, but we do trade to an old previous low. We have this old low that's here. It doesn't touch it, but it takes out this liquidity and then rolls over again. If you're bearish on the daily, but in deep discount and at a key level, I probably wouldn't. So if you're bearish on the daily and it's at a deep discount, I would only turn bullish if we get a closure above an old bearish candle or we get an inverted fair value gap. So here, right? This is maybe where, let's say if I'm bearish, for the time being, I have to put that on hold until we get back through that level. All right, so this is our bullish inverted fair value gap. And right now, this market is still bearish, right? As long as we stay below this this fair value gap and this fair value gap and this volume imbalance in here, I'm remaining bearish on the dollar. Right? These should be red. All right, so this is basically how I sit down. I mean, I will sit down and usually go over and annotate much more of this. Like every single week and every single day, my charts will look much more in-depth than this, right? And I'll have notes in here. Like I'll draw an arrow, just say here, we ran out previous day's high, right? You can just type in some text, say ran out. I wouldn't say this is really back testing because I'm not placing trades. I'm not placing trades in here and back testing that. But I am analyzing the markets to see where I went wrong or where I missed out on opportunity or what I did right. Right? Because this is just all about repetition. When you sit down in front of the charts, if you study enough bullish fair value gaps and you see it enough times and you see months play out enough times where it's trading around the monthly open or it's trading to internal range liquidity, you can position yourself with the anticipation that it's going to do what you previously had seen, right? And not every trade that you take is going to pan out exactly as you saw previously, but if you recognize the patterns, that's really all you're trying to do. You're trying to recognize the pattern that you had seen previously, position yourself properly with the right risk management, and hope for the best. Because once you're in the trade, you can't determine if this market is going to run through all these bearish fair value gaps. You're just anticipating that this pattern that you see over and over again and the direction that the market is currently trading is going to continue. And that's all you can do. So let's hop over to NASDAQ real quick and we'll basically do the same thing. So last year, right, closed bullish. And we're possibly just anticipating maybe just a retracement into this yearly order block. But as long as we stay above this down close candle, and now this yearly ran out the previous yearly low and then turned around. So right now the index markets are just bullish, right? The hope for the best part is the hardest part to learn. Yes, it is. Because you cannot control what the market is going to do once you're in the trade. All you can do is rely on the analysis that you've done and position yourself properly and trust your system enough to not tamper with it. All right. So once you place the trade and you have an anticipation of what that month is going to do, you have no control over it past that point. So let's go over January, February, March. Let's go over the whole year for NASDAQ. So here we have January, right? We take out this short-term low in here. And then it trades up into a bearish fair value gap. It trades up into a bearish fair value gap, then rejects lower. Right, taking out this short-term liquidity. Once it takes out the short-term liquidity, we get a very strong bullish closure through this bearish fair value gap, right? And then we get a bullish inverted fair value gap. And we run to short-term liquidity, right? Again, internal range liquidity, it doesn't always have to get ran out if you are bearish on a market, right? So you have these two short-term liquidity points, right? We took out one of them. And then it rolls over. All right, so we take out this liquidity. And then we get a bearish engulfing candle here, which I haven't been mentioning the engulfing candles. But this candle here is an engulfing candle because we take out the high and the low. Right? And it closes bearish. And you guys can see here on the rollover, this market gaps down and it flushes out a lot of the long positions here. And then it kind of just goes sideways into the end of the month. So this was very sloppy, in my opinion. But then we have this previous monthly high that's here. So we have this previous monthly high. Extend that forward. This is very sloppy and sideways intraday. So it, for me, was very difficult to try and determine where we're going to go to. We trade up to the previous monthly high, and then we get a rejection. Okay, so let's say if you struggled in all these days here, maybe you just have to wait patiently for the next trade. Maybe you want to trade a different market. But once we get a clear signal where the market wants to go, right? We have this old swing high being taken. So we run out this buy side liquidity, and then we get a strong closure here. This strong closure is a bearish engulfing candle, and it closes through this bullish fair value gap. So not only do we have a bearish engulfing candle, now again, these candles don't produce wins on every single trade that you take. Okay, they probably work 50 to 60% of the time. The other 40% of the time, 50% of the time, is turning around and going higher. Again, you're trying to make an educated guess, and you're not trying to assume that you're going to have a 100% win rate. So this turns into an inverted fair value gap. Let's say you struggled in all of this price action here. Maybe you caught along on one of these days. That's great. But you can make it all back if you are in tune with where the market wants to go on these days. Right? So leading up into the end of the month, you get a very strong closure here. And then you can lean short the next couple days. And these 3, 4, 5, 6 days can make up for all of this sideways price action if you protect your capital long enough. All right, so we have this low resistance liquidity, right, or trend line as our target. So we run out the previous monthly high, then we take out the previous monthly low. And guess what this creates on a monthly time frame? All of this price action in here, we take out the high and the low. What does that create? A bearish engulfing candle on the higher time frame. Right? So if I go to the month of February, you should see a bearish engulfing candle. Right? This is a bearish engulfing candle. We took out the high and the low. So this market just continues lower if you just stay on side, right? And then anticipate some type of retracement. Now the retracement in here, again, is a bit dicey because I don't really see any level in here that it really should respect other than a fib retracement. We have, I would say, this swing high, right? Because these are not swing highs in here. So you got to draw your fib from here down to here. And it just trades back to 50%, basically, 61%. and then it just continues lower. So there's not too much to talk about in here. You know, maybe you want to get long on these closures above these down close candles, but again, if you have to properly manage your risk and your targets, because the run higher it's struggling with, right? Because that's high resistance. You're trying to trade long inside of a bearish trend instead of waiting for the market to show you when it's ready to roll over, right? It rolls over here with this bearish engulfing candle. So we get another daily bearish engulfing candle over here. And then you can lean short again. Right through April. And then once April opens up, the first day of April trades into this fair value gap, right? And then gaps overnight, right, on the rollover, trading lower. Taking out what? A lot of this liquidity. So we take out these equal lows all the way down here. This is, I'm pretty sure this day here was tariff news, which is why we get this large cascading run below these equal lows. So we get this massive run lower, right? And then we get a large spike higher, large bullish engulfing candle, trades lower into a discount, right? So if you measure this swing high or swing low to this swing high, comes back down to 61% and then turns around. You know, maybe you want to position yourself long on a closure above this down close candle. And then going into the end of the year, well, let's talk about June or May. May, we have this gap, volume balance, new day opening gap, whatever you want to call it. To me, it's all the same terminology. I don't know where ICT came up with volume imbalance or new day opening gap or new week opening gap. A lot of times they're occurring on the rollover anyway. So we have a gap. To me, the terminology doesn't make a difference. I'm still trading a gap, right? Trading down into the gap continues higher, right? If you position yourself long in here, you have a lot of liquidity that can be taken out. Then we get a retracement down into this fair value gap. Right? Continue higher. Taking out all of this buy side liquidity. You have another bullish fair value gap here leading into what? June. June was a little bit sideways, right? Because we're taking out short-term highs in here and then it's retracing. So every time we take out a short-term high, it's retracing because the market is just accumulating more longs, right? So every time we take out a short-term high, it retraces. Every time we take out a short-term high, it retraces. And we take out this liquidity, right? We have this candle here that doesn't have a wick, like I mentioned. Very important, in my opinion, to watch these levels because oftentimes we can take those levels out and then turn around. So we took this level out and then turned around. Get a nice closure here above this down close candle, and then it trades to this short-term high here and then continues higher. Right? There's no retracement down to like a bullish fair value gap or anything here. So you have to just try and position yourself properly. Intraday maybe. And July was just more of a drift. To me, it was a very difficult market to trade. So unless you're really positioned long and just holding, intraday, it's very choppy, right? Because we're just stuck in a range, and then we eventually get a range breakout here. So we have this here as our range. I would wait for this closure here. Right, so this closure outside of the range creates a fair value gap. And then maybe you can position long for the following days. And then obviously leading up to the end of the month, you have to be very cautious because at the end of the month, people are trimming their positions. They're not holding through monthly rollovers. Okay, they're usually trying to take their profit for the month and then position themselves again for the following month. Here, we don't see anything down here that I would really look at because we're not really respecting this fair value gap. But maybe we're waiting for this daily engulfing candle. We have a bullish engulfing candle here, a nice closure above this down close candle. And then we target the previous monthly high. We take out the previous monthly high, and then it fails to stay above it. Right? You get a closure, and then we just get a retracement. Then we get another bullish fair value gap here with a bullish engulfing candle. But here's where sometimes these candles don't always work. We get a run on the low. So this rate on liquidity then turns around and goes higher. So this is actually September here. And then all of September is basically just bullish. There's not really opportunity where it pulls back. You're just trying to trade intraday and position yourself below, lower in the wicks as this market trades higher, right? You do have a fair value gap retest here that comes later in the month, right? We have multiple fair value gap retests here, and then the following days resume higher, right? Another fair value gap here, and then resumes higher. Here we have previous monthly high. We get a flush, right? So this is very sideways price action. Maybe you don't anticipate this flush lower, but it takes out this swing low and this swing low, and then it trades higher. I will say the last couple months in the last quarter in index markets have been much more difficult to trade than earlier in the year. All right. They haven't really provided those higher time frame levels that I typically like to trade off of. All right. Then we have this gap here, and then it trades higher. Here in November, right, we get a very strong flush lower. So we have a lot of these buy side imbalances being ran out. We have a bearish fair value gap that doesn't get retested. And then it rolls over. I didn't really find too many trades in here other than maybe losing this bullish fair value gap. So we lose the bullish fair value gap, and then we get a bearish fair value gap here. And then these couple days would have been good short opportunities. Here and then in here. Running out the previous monthly low. After we run out the previous monthly low, however, we run all the way back up to this short-term liquidity. All right, we take out this liquidity and then retrace down to where? There's nothing really in here other than a fib. Right, so we trade down to 61%, and now I'm targeting this liquidity here. And this is just what I do, usually at the end of every month or even at the end of every day, because when you drop down to your daily chart, right? If you drop down to your daily chart, I'm usually marking out the beginning of the week. All right, so maybe this is the beginning of the week. Every single day. So we have our midnight candles. And I'm doing the exact same thing, right? So I'm coming in here and I'm annotating every single day. What do we do? Did we run out the previous day's low and then turn around? Right? We get a nice closure above this down close candle, and then the market trades to where? The previous day's high. Right? If we do not reject the previous day's high, we come back into the markets and we have a bullish fair value gap. Well, I'm watching this level to see if it's respected. You guys can see here that it is respected. And basically, this is what I do. I segment all my data and I analyze, so that way going forward, I know what to anticipate, or I have a good understanding of what I'm going to try and anticipate the following days. What looks bearish right now? Index markets? Index markets do not look bearish right now. All right, so if we look at the weekly time frame, this is just a retracement down into this order block. All right, this market is still creating higher lows, higher highs. We're just taking out short-term liquidity. So these lows down here, this previous monthly low is just short-term liquidity. and I'm targeting external range liquidity, because if the market is going to go trade higher, it should take out all these highs. If it's going to keep going higher, it's going to take out all these highs. So this is typically what I do, right, as a recap, to try and just build the skill set of analyzing markets properly, knowing how to protect my capital, because I know the markets are going to go through periods where I just don't understand what it's doing. So the market just drifts higher, like in all of this price action in here. There are some days where I just don't know where the market's going to go. So like all of this in here, I didn't know where the market was going to go, right? Even up here, until we get a range breakout, right? And then we get a bullish fair value gap. Then it's more clear to me where the market's going to go. And I'm okay just sacrificing these days, because I know there's going to be days where I just don't have a good read on the markets. And I'm not trying to sit here in front of my charts and just trade all day long. That to me is not profitable. All right, I'm trying to take advantage of the days where it really runs in my favor, and I can really take advantage of that. Right, days like this, where the market rolls over, and now all of a sudden we get this nice, strong bearish fair value gap, and I know I can lean short all the way down to where these equal lows down here. Right, so if I have a high time frame target like this, am I in a rush to trade down to those levels? No, I'm not. But I'm going to keep staying on sides as long as the market creates lower lows and lower highs and keeps respecting bearish fair value gaps. Because on days like this, where we have these large daily expansions, we have a large daily expansion like this, and then a large daily expansion like this, and a large daily expansion like this. Even on days like this, where it eventually doesn't keep going, right, I can still take advantage by just at least being on side with the direction that I'm trading. Yes, there are days where it trades higher, but I'm just trying to catch the bearish days. I'm not trying to catch any of the bullish days if I'm bearish, right? I'm trying to protect my capital when the market's going higher. That way, when I do get a bearish setup, I just take advantage for that one specific day. And if I'm trying to swing trade, maybe I leave a runner on for all the way down here. Yeah, you used to try to dictate what the market's going to do next before I watch how flexible you are with. You have to be flexible with markets, because sometimes the markets don't do what you expect them to do. That doesn't mean that you're wrong on the analysis, right? Because if I didn't anticipate the market going sideways like this, but then I start getting bearish signals again, where we get a breakthrough this bullish fair value gap, and we get a bearish engulfing candle, and then we get a nice expansion down here, and then we get a retracement into this bearish fair value gap. If I just abandon that idea because I get frustrated, then I never can capitalize on the actual run to the target that I'm anticipating. Right? So you have to be flexible in your analysis, because not all of your analysis is going to pan out. So let's say if you wanted to be bearish from this fair value gap, and then it just drifts higher and higher and higher. Do you all of a sudden flip long and anticipate that we're going to run out these highs now? Right? That's a battle that you guys all have to deal with. Right? And sometimes you are going to miss out on moves. And it's just about aligning yourself again with the next highest probability opportunity, and stop and don't worry about the loss that you just took, right? Because there's going to be more opportunity. I'm not going to show you how I trade gold, but I would do the exact same thing that I just showed you guys. So if you guys missed out on how I sit down and analyze all of my charts, like Euro and NASDAQ, go back through, or sorry, dollar, NASDAQ, go back through and start doing all of this. Right, start plotting all these levels out and get screen time. Right, and if you don't want to do this on the daily time frame, right, which is probably where you should start, because the daily time frame allows you to actually slow down and think for yourself without trading too much. Start doing this and start paying attention to price action on these higher time frames, because if you can think slowly like this and see where the market's going, you can start speeding it up and start trading the lower time frames. But until you can understand how to do this on a higher time frame and understand the framework of how a monthly candle forms and how a daily candle forms and how a yearly candle forms, then I probably would stay away from intraday trading, because you don't really know how the market operates. Right? Think about trading lower time frames as mastery. Right, you start out, and I'm just going to make an analogy as like somebody that is in medicine. Somebody that's in medicine, right, that wants to perform surgery, do you think they're operating on a live person? No, they're probably operating on like dummies, cadavers, people that are already dead, right? That's a practice environment. And then when you get to the lower time frames, that's like being a brain surgeon. You have to think very quickly. You have to know what you're doing. And if you can't think that fast because you don't have the experience, slow it down. Trade the hourly, trade the 4 hour if you're still trying to get a bunch of reps. But I would stay away from the lower time frame. It's the same thing. I don't think I have to walk you through it. It's the same exact thing. So like the way I'm marking out my monthly time frames is exactly how I would mark out my daily time frames. I think I just showed you guys what I do on the hourly time frame. So when I'm marking out my hourly time frame, right? If I have this previous swing low from the weekly open, or I have this previous daily low, this is the exact same thing that I just showed you guys of us running out the previous monthly low. It's just happening at a faster pace. All right, so pretend like this hourly low is your monthly low. All right, if we go to the daily time frame, this is the exact same thing. We have the previous monthly low here. This is the exact same thing. This pattern recognition. But can you spot this on a lower time frame that fast? That's the difference. Here, you have days to think about this. You have multiple days to think about this, or multiple hours and multiple sessions to think about this. Whereas here, you have to make a decision in the next hour, otherwise you're going to miss the trade, right? If you even wait 2 hours, you basically miss the trade because it's already at the previous daily high. Whereas if you miss just 1 day, if you miss 1 day, you still have all these days to trade to this swing high, right? So it just slows down. The markets slow down when you trade the higher time frame, but the setups are still the same, right? This previous monthly low, right? A rate on that and a rejection is the same exact thing that you're seeing on the hourly time frame. A previous low, rejection. It's the same exact thing, all right? So I'm going to hop off here, guys. This is how I sit down and recap all of my trading, right? And it will help you trade live setups because you know exactly what you're looking for. If you do this enough, if you segment all your data and try and understand, if I have a really bad week trading and I don't sit down and annotate, I don't learn anything. All right. If you have a really bad week trading, you don't learn anything because you're tunnel vision. You're just like, you kind of chalk it up to bad luck. Whereas there's usually always a reason for markets that turn around and stop you out, and you learn how to avoid those trades, right? You just get better at anticipating the market. And that's all you're trying to do, is trying to anticipate the market at a 50 to 60% win rate. That's it. But that doesn't mean you have to be correct 100% of the time. Okay, I'm not correct 100% of the time, and you guys should not put those standards on yourself, because that is a way for you to blow up your accounts, and eventually you're going to quit because you're not winning on all of your trades. You're probably in the wrong business if you think that you're not going to have losses, right? So I hope you guys learned from this. Take this practice going forward next year, and do this every single week. Right? I don't care if you just mark out your weekly opens. So if I was studying the weekly time frame, I would just use the 4-hour chart. Mark out your weekly open, right? And then divide your weeks and study what price does on the 4-hour time frame, right? I don't know exactly where, let's see. Where are these weekly opens? Here we go. Here we have a week, and leads up to did I miss a week in here? 14th, 15th, 16th, 17th, 18th, 19th. No, so this is 1 week worth of price action. There's a lot to study on the 4-hour time frame, right? You have this bearish fair value gap appearing here, right? Then we get a run lower, taking out a bunch of liquidity. Then we get a bullish engulfing candle, right? Inverted fair value gap. Just trading into an internal range liquidity. But again, the internal range liquidity is a hard target because this market is bearish. So where is it going to trade to? We don't really know that. We just have our fair value gaps marked out. Then we get another bearish engulfing candle, and then we get another run lower. And then it stalls out, and then we get this inverted fair value gap, and then it's been higher ever since. Right? So if you're just trying to study week to week, this is what you should do. You should be annotating your charts, figuring out what every single 4-hour candle is doing with context, right? You're working with low risk reward trades like 1-to-1 to 1.5 hour. What's your advice to improve it? You just got to start trading higher risk reward and see how it works out. There's no shortcut to this. The advice is to just put in the work, right? So start trading 1-to-2 risk reward, right? Find better trades and just put a 1-to-2 risk reward, and you have to leave it alone because those trades are going to run longer than your 1-to-1s. Theoretically, they should be twice as long, right? If you're aiming for a 1-to-1, if it's going to go to 1-to-2, if your average hold time is an hour, you might be holding a trade for 2 hours, right? So I'm going to hop off here, guys. Again, midnight open for everything. Use midnight open, so 12 Eastern. But here, on a weekly time frame, I'm using 6 p.m. because that's when the futures market opens on Sunday. So you're trading Sunday, the Sunday or Friday close. So this is a Friday close. Here's the Sunday open, right? But it doesn't really change that much, all right? So I'm going to hop off here, guys. I hope you guys enjoy the weekend. Again, this is how I sit down and annotate my charts, okay? It's a very simple process. It doesn't take you a whole lot of time. And you're just trying to put yourself in a learning environment where you're trying to anticipate the next trade, right? And try and figure out, okay, if I went wrong somewhere, where did I go wrong, right? Was I trading against the trend? Did I see things or did I miss things that I should have seen? Right? That's what you're trying to do. You're trying to segment all your data. Let's say you're doing it on a weekly time frame. You should be taking a snapshot. So once you annotate this, like bearish fair value gap, blah, 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 you know, you can annotate the hell out of these charts. Save it. Save this chart. I don't care if you have to look at it again, but at least it's like imprinting it in your mind on what you should be looking for. Right? Don't just sit in front of the markets and trade live without doing any of this stuff. Because I guarantee it's going to have a big impact on your trading. All right, so I'll probably see you guys next week if I don't take the week off. I'll check with the team. You know, if I don't see you, happy holidays. You know, enjoy the new year, and yeah, have a great one. Take care.